Alright, we are going to start the webinar. I welcome everyone on this webinar today. I hope that you hear me well. My name is Stanislav Bernuhov. I'm a trader with more than 11 years of experience in trading Forex futures and CFDs. And today I will be your host. I hope that you hear me well. If you have any questions, you can ask your questions in chat. We will pay attention to your questions in the second part of our webinar. And today's topic is trading reversals. We will talk about trading reversals. All right, that is today's topic. Well, traders often start their learning process with reversals. They very much like reversals. Reversal patterns, whatever it can be, I don't know, head and shoulders, double tops, double bottoms, and other patterns that might help them capture unfairly high or unfairly low price. But possibly it is the most tough trading style or tough trading strategy because expected value of the strategy is pretty low. In other words, you can capture 4 losses out of 5 trades if you don't filter your trades, if you don't know how to estimate market conditions. You just can't fade the price. Once price goes higher, you cannot just fade the price or identify candlestick patterns, simple candlestick pattern like engulfing pattern or other one to go again to capture a reversal. It requires much more than that. And we will pay attention to nuances of trading reversals in this webinar. Alright guys, I hope that you see my screen. Let's once again check it out. You should see the slide trading reversals, the head slide now, and you should hear my voice. If everything's okay, we will proceed with the webinar. Just let me know in chat that everything is okay. Alright. Everything is okay. All right, let's start traditionally with a disclaimer. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. Risk of trading in financial markets can be substantial and you accept full responsibility for any of your trading decisions. Past performance is not a guarantee of future returns. With that, we are starting our webinar. All right. First of all, this webinar is not about top or bottom picking. I want to distinguish trading reversals from top and bottom picking. This is very important because what is a top and bottom picking? Once trader identifies the market which is rising or falling, or in other words, aggressively goes higher or aggressively goes lower, trader starts to capture a top or capture a bottom. That's not what we are going to do because it is a strategy with negative expected value. In other words, if you see this slide, if you see this chart, you might note that most of the time or many times market will tend to at least test previous extremes and renew extremes. It is very common behavior of the market. And if you try just to go against the market, it will not work that way. It is very mechanical. It doesn't work that way. And you see that we have many new extremes. And if you're going with the trend, with a strong trend, you will tend to capture swings in the direction of this trend. And I don't know, you can earn a winning streak out of 7 or 10 trades in a row. If you go against the trend, it is much more difficult, but also the profit-loss ratio for reversal trades can be substantially higher because if you go with the trend, you see those pullbacks, those correctional moves, and of course, sorry about that, about those notifications, I will just close them. All right, when you go with the trend, not every time you have very good profit-loss ratio because when market is young and it breaks out from a range, possibly you can capture a small pullback. You can place a tight stop and go with the trend. Even if we're talking about day trading, also very good opportunities with asymmetrical profit-loss ratio you will find only in Yan trend state. When market goes higher and higher and higher, every bar or every candlestick will be without any shadows. It starts growing from the beginning of the day, and later on, as the trend develops, market becomes choppy. It goes back and forth, and it's much more difficult to capture small trade with a small stop, with a tight stop. Nevertheless, we can capture a reversal trade because, as you might see, currency market especially, well, many markets, but currency market especially is a market that goes in a range-bound manner. It's not going to go in a trend without corrections, without pullbacks. It is a very rare situation. Most of the time, if it is trending market, it goes in a wave-like mode. It goes in a stair-stepping mode, and even if we are trading counter trend, we are able to capture a reversal trade from the upper side of the range and from the lower side of the range. It doesn't matter. And that is our webinar all about. All right, breaking a trend is not a reversal yet. We will not try to search for points of a breaking trend, because many traders, they think that if trend breaks, it is going to reverse, or at least go to the deep correctional state. It is not necessarily so, because most of the time trend is going to turn from bullish to sideways rather than from bullish to bearish. And again, at the opposite, if the trend is bearish, if it breaks, it does not necessarily turn to the bullish. It will first possibly turn into sideways. So there are many scenarios when market turns into sideways action after the break in the bullish or the bearish action. So breaking a trend is not a reversal yet. But what is a reversal? All right, of course there are many time frames, many perspectives. You can trade within a day. You can be a day trader. You can be a swing trader with a duration of trades less than 1 week. You can be a position trader. And there are many time frames. We will start to talk about 3 approaches. The one is day trading, the second is swing trading on 4-hour charts, and the third one is position trading. All right, going with and against the market. When do we want to go with the market? It is very essential to learn or to know when to go with the market and when to go against the market, because if you trade reversals, you should pay attention to the points in the right column. All right, when we want to go with the market, we want to go with the market when we have new business come into the market. When the market is emerging, sorry about mistake, market is emerging from long-lasting trading range. We have volume and open interest growing or increasing. Possibly it is a confirmation. Also, we may want to go with the market when we have thin market or potentially volatile market. For example, when there are holidays, or when there are news ahead, news announcements ahead, market is thin. When it breaks some level, it tends to go in a volatile manner, in the volatile mode. It tends to break this level and go in even higher or even lower. It is for day trades, right? And also, we might want to go with the market when we have dominating trend, dominating Yan trend. It's easier to test extremes rather than to reverse, at least for a short-term perspective. When do we want to go against the market? We want to go against the market when we have an outdated trend, when the late majority phase of the trend is in play. Well, some of you may know the diffusion model. When you have early majority, we have early adopters, we have late majority. Late majority is a culmination, it is a final stage of a trend. Also, we want to know whether action is not supported by other time frame, buyer or seller. When market is dominated by day traders, we want to go against the market, because short-term traders and day traders, they build insecure positions, and we might see rapid liquidation to the downside if we had buying activity, or to the upside if we had selling activity. So, in other words, we want to know when weaker-handed traders are caught in their positions. In other words, their inventory is long or their inventory is short, and we want to know how to capture those situations. And also the last point is informational risk, small informational risk. What does it mean? When you have very clearly identifiable setups which are visible for the majority of traders, you know by definition that they are visible to the majority of traders. You also know that 90% of traders see the same. For example, if we're talking about very obvious support and resistance levels, it is possibly not wise to buy at the third or at the fourth test of this support and resistance level, or at least you should be aware of possible shakeouts or possible manipulations around this level. And sometimes you can go against this level to gain a short-term perspective, gain a short-term edge. All right, guys, I will watch chart from time to time because I don't see the chart when I'm speaking. All right, you have a question. All right, just drop your question here, and I will get to this question later on and try to answer your question. I will pay attention to questions from time to time. All right. Going with the market and going against the market. We will watch charts now, so don't worry if you don't understand something for right now. I know that it is pretty abstract for the present moment. I will try to decipher and I will try to explain things that I'm talking about. All right, fade in the correctional move, fade in the correctional move. Of course, if you have a very good trending condition, you can employ the characteristic of a trend to renew extremes. And it is not a reversal, of course. It's going with the trend. It's short-term reversal of a correctional trend. Most of the time, if you have a very good or young trend in place, you can initiate very simple strategy. For example, you can set up an envelopes indicator or a Bollinger Bands indicator, and you know that pullbacks possibly will not be very volatile. Pullbacks or corrections will not be very deep, and so you can sell here. But you should be aware that you are working counter trends, so your stop cannot be very tight, and that's why your profit-loss ratio will not be very good as well, because your targets are also very small in this case. And possibly they gravitate to 1-to-1 profit-loss ratio. It's not a big deal, and that's why I mostly don't like to work in the condition of, I don't like to capture pullbacks like I'm showing you here. Another way to capture pullback is trading within a range. I will show you such setups later on. The latest or recent trade made from a pullback was initiated today. It's New Zealand dollar. I have executed on the second account. I will show you the screenshot of this trade. All right. That's the first thing, fade in the correctional move. Let's start with that because it is also a reversal trade. We are, in this case, working with the correctional trend, but it is also a trend. Though it is a short-term trend, it is also a trend. Well, there are two major ways to do that, to fade the correctional move. First of all, we have to be aware that the trend is strong, that it is gaining momentum, and it is developing in the direction of a trend. How do we know this? There are some charting principles to do that, but I start my day with analyzing COT reports. COT reports, which are reports showing volume and open interest. I will show you it very briefly. It is a very big topic, actually. We have to possibly make a separate webinar on this topic. All right. We don't have the centralized information about volume and open interest for Forex market, though we can analyze future markets. There are currency futures. We don't trade currency futures, but we trade Forex. We can analyze volume and open interest from the currency futures. And if we see the trend, for example, you see the Australian dollar, right? Australian dollar, it is going down for right now. And if you want to see the underlying force behind this market, you see that we have two lines. One is green line and the second is blue line. I remind you that I'm watching this information on the website www.timingcharts.com. It aggregates data from cftc.gov. It's a U.S. Commission for commodity markets. All right. If we see that the green line is located above the 0 point, which is the dotted point, it's the 0 point, it means that we have positive delta or positive relationship between longs and shorts for the large traders. Most of the time, the good trend or long-lasting trend, at least that can last for 2 or 3 months, can start with the positive delta. Remember what we had in February. We have green line crossing the 0 line, and we have 3 weeks of growing delta, right? The reports are released every Friday, 3:30 p.m. New York time, so it's late in the evening. We can use this information in Monday, and this information aggregates data before every Tuesday, so we have possibly a weekly lag. But for example, in this example, we had three weeks of growing delta, so the trend is young, right? The trend is young. The trend is young, so we can possibly capture pullbacks here. Well, for now, if you have the Australian dollar, it's not a young trend. We don't see any growing, any corresponding delta from the timing charts. If we had a negative number of large traders, it will be good information for us. It will be confirming information. Nevertheless, we have trending activity, right? We have trending activity. Well, and to spot this trending activity, well, we see that market was unable to get back to the previous trading range. And of course, if you, for example, capture to daily chart, you automatically see that most of the candlesticks here, most of the daily candlesticks are elongated. Market is not even trying to get back to the previous trading range. And we see several elongated daily bars. And that is an action. So it's much easier for the market to renew lows, or at least to test lows. Even now, when the market is already traded at lower points, it is easier to test lows. Well, we can do very simple thing. We can do very simple thing to capture a pullback here, to play a reversal. We can use envelopes indicator. Let's start with a very simple method. We can use envelopes indicator. Well, when we are using M30 minute chart, I would possibly set more broad period. I have 21 period for intraday trades, but if I want to capture pullbacks with a larger time frame, I possibly will set maybe 150, right? Something like that. And I also have to increase deviation. Sorry, I have decreased it instead of increasing. All right, all right, that's the way it is. That's the way it works. You see that the last low that was, well, not the last low, the previous low that was formed between May 13 and May 16, we have seen the crossing of the lower border of these envelopes. We see the crossing of the price and the lower border of the envelopes. Then market had rallied higher, and it slightly was unable, maybe a couple of pips, to reach this point, reach the higher border of these envelopes. So that's a trade location. It's possibly a 10% or 15% area from the upper side of the envelopes. You don't need to sell exactly on the upper side of the envelopes. You just need, you may use any filter. You may enter, I don't know, 15 pips or 20 pips below the higher point of the envelopes, because in a trending condition, in a strong trending condition, market usually is unable to reach the highest band of the envelope. And you see here that your ATR point is equal to, it is 21 also. It is 21. Let's also apply parameter of 150. What parameter do we have now? It is, again, it is 11 pips, right? It is 11 pips. So if we enter this position, for example, here, we want to know the value of the upper side of the envelopes. It is 0.7377. We multiply the ATR parameter by 2 and get 22 pips above this point. So in this case, it is 73.99. Right, 73.99. Pretty tight stop, right? Pretty tight stop. It's not 1-to-1 profit-loss ratio. It's slightly higher. If you know that market will possibly reach the extreme, you have 2-to-1 profit-loss ratio, which is better in this case. It is a reversal, right? It is a reversal. But once you have a good trending condition, you can capture a reversal not even watching for any setups. It is a bit risky, but that's the way it works. In a strong trending market condition, you don't need to watch for any setups because there will be no setup available because market is quickly absorbed. Market is quickly pushed down from this price, and you will not ever have the opportunity to wait for a setup because market is quickly pushed down and reaches the extreme in 2 days. All right, guys, I will watch the chart. You have emails. Is the indicator effect on our earning? Please rephrase the question. I don't understand what this question is about. Do indicators have effect on our trading? Well, indicator is just a tool. Indicator is just a tool. They don't affect our trading because it just organizes the data. It helps us to organize the data. It is just a tool. Well, it is not. We might not need the indicators. It is just an example for pullback trading. In pullback trading, I use this indicator because it is relatively easier to identify the approximate area to sell or to buy. If you use envelopes, you might not need to use envelopes, but most of the time it is pretty good way to go. I use 2 indicators basically. It is envelopes and it is average true range, which is ATR. It is indicator that measures volatility. Which indicator is easy to understand and accurate? Well, I'm talking about those indicators that I use in my trading. The most important indicator, in my opinion, is ATR, or average true range, because it measures volatility and it can help you spot very good opportunities. The second is envelopes, because it can help you capture pullback trades. All right, that's the way it works. You see, you capture pretty quick trade, you capture a correctional move, you capture a pretty quick trade, and you work in the direction of a trend, because most traders try to fade the action. They will start immediately searching for a reversal pattern somewhere here or maybe here. And if you know the psychology of the majority of traders, you know that you want to be on the other side of the market. You don't want to be in a group of losing traders, because many bottom pickers are losing their money very quickly. All right, that is just one example. And the second example, it is today's trade. It is New Zealand dollar. I have entered this trade on my second account. I will show you today's screenshot. That is a screenshot of a sell limit order. Sell limit order was opened at 0.7658. It is not a trending action, right? It's not a trending action because its market is located inside of a trading range. But what do we have here? We have here a very important point. Well, the overall pressure is the overall trend for the American dollar is growing, right? Most of the markets are falling. But here we observe that the market was unable to reach the extreme at this price action. It was unable to reach the extreme. I will show you it on a chart. Let me show you it on the chart. It's not that, sorry. All right, that's a New Zealand dollar. First thing that we pay attention to today is that market was unable really to reach the extreme. So it goes down but is unable to reach the extreme. Well, I know that market will tend to break the trading range and to reach the area beyond the extreme point. When it breaks the area, when it breaks the lower area of a trading range, it wants to trade below this range. Why it is so? Why is it so? Even if we don't have any trend, market tends to break the extremes and go outside the extremes, because that's the way it works. Because here we have stops. Here we have other traders that try to buy on a pullback. Here we have other traders. Well, the most of liquidity is located here. Nobody really wants to trade inside of the range. Everybody wants to trade outside of the range. There are momentum traders that go with this breakout. All right, there are momentum traders that go with this breakout. There are stops located in this area, and there are also counter trend traders operating in this point. So market wants to go to this direction. I call it the target area. So if I have seen that the market is building a small trading range just below the target, the target area, I can also initiate a pullback trade. And I apply the intraday parameters for my ATR, which are I use 21 parameter for an entry, for my envelopes, and I use, well, around 35 or so, I believe. Well, it's a very big number. I have to fit this number to the current market. That's the way it is. All right. 0.3 is a deviation, so that's my point of entry. That's my point of entry in the direction of the target area, which is located below the trading range. Well, it is, how do I calculate the target area? How wide is the target area? I'm not sure that the market will visit the target area today, but to identify it, I switch to the daily chart. I watch the ATR on the daily chart. ATR should be of 21 parameter. Okay, it is 21 parameter. I want to know what is my value of ATR for right now. It is 69 pips, right? It's 69 pips, 70 pips. The low of this candlestick, or the lowest value of the trading range, is 0.6715. So I subtract 70 pips from this point, and I get 0.6640 or so. Well, it's not a math. We don't need to be very, very detailed and very specific. All right, that's my target area. That's my target area. So I will work in the direction of this target area. So possibly I might gain something around, I don't know, 70 or 100 pips in this trade if market will go. Well, of course, market cannot go because I have reduced this risk for this position. I have entered a position at 60 or 57 or so, or 57, right? 67.57, sorry. And I have placed my position to break-even point, so it can be captured. Well, but if not, if market will continue going down, I will exit somewhere at 0.6670 or so, maybe lower. All right, how can you repeat how do we use the COT reports from timing charts? All right, let's repeat it once again. This is a pretty complicated topic. I know that most of traders are unfamiliar with futures trading. All right, we choose the currency pair. We go to the timing charts. We choose the currency pair from this list. For example, it can be British pound. Let's select British pound from here. And we have COT here, the button COT pushed here. We have daily bars, and we have linked contracts. We have linked contracts, right? And we have two lines here. Well, nothing significant is really happening for right now, but there were interesting clues or details on Canadian dollar. Canadian dollar is the Canadian versus American dollar. The currency pair on the Forex is American dollar versus Canadian dollar. It's a reverse chart. All right, we see that we have 4 weeks of growing delta on the side of the large traders. At the same time, market is going down. You might know that market is going down, right? And you see growing delta, 4 weeks of growing delta. Large speculators, they accumulate this market, they accumulate positions at this, and market is going down, or the American dollar versus Canadian is going higher, right? It is going higher. We should pay attention to this fact because it's a sign of possibly young trend. So first of all, we should be very careful going with the break on the Canadian dollar. Let's put this chart on and see what happens there. It is going higher, right? It's going higher. There's pretty nice trend in action, but we should be very careful with this section because we know that 4 weeks large traders or large speculators were accumulating long positions for Canadian dollar, or in other words, they were accumulating short position for American dollar versus Canadian. So I will not be surprised if I will see market going down to the previous areas. And that's why I can afford trading reversal in this market. I will later explain how to spot such reversals on such situation. It is a pullback. We are not applying any envelopes here because it is very large swing. We can use envelopes indicator for small pullbacks, right? For the small pullbacks. This is a very large pullback. We cannot use envelopes here because our stop loss will be very distant. Later on, I will explain you how to trade those situations. All right, let's get back to the presentation. Another example is from Swiss franc. It is American dollar versus Swiss franc. And again, extreme zone or the target area located above the extremes is here. The market tests this target area and immediately is pushed back. And we can use envelopes to enter our position because we know that the destination of this trade is target area, this extreme area located outside of the range. All right, that is our entry point. We set our stop loss using the ATR, and we're going in the direction of the target area. I will show you this chart. All right, it is Swiss franc. It is Swiss franc. All right, first let's start with the daily chart. Every analysis is good when you start it with the daily chart. And on the daily chart, you see two extremes that are very visible and are very clearly identifiable. Number 1 and number 2. The number 1 was formed in March and number 2 was formed in April, right? Two extremes. Then after trying to break out lower, market gets back to the range and initiates pretty strong trending action. We see a lot of white candlesticks, market is supported, is go higher and higher, and eventually market ends up with consolidating right below the point 2 or right below this resistance area. Many traders would like to prepare to enter a short position. That's the typical behavior of the traders. They will prepare to enter a short position here. And for that reason, it will not work because that's what I call informational risk. Informational risk is too low here. Too many traders see this level. Which is 0.9789. Too many traders see this level, and for that reason, it will not work. But nevertheless, you can capture short-term trend or short-term movement to capture a breakout to the target area. In other words, you want to capture a breakout to this area, right? That's what you can do. To do that, you switch from the daily chart, for example, to the 30-minute chart, or to, I don't know, to hourly chart. For me, it is better to use 30-minute chart because it shows more details or slightly more nuances. Well, we have seen the attempt to break out the level and immediate liquidation to the downside. Market reaches the lower band of the envelopes, right? It is the price. It is the price. Let's see what the price it is. It is 0.9760. Our ATR is equal to 10 pips. It is as small as 10 pips. So we can enter a position at 60, multiply ATR parameter by 2 and get our stop loss at 97.40. It can be 97.40, right? Because we multiply 10 pips by 2 and we get pretty tight stop here. But it is a technical thing. It is a mechanical thing, right? Before doing that, we might decide to go with the market. We might decide why should we buy here. First is an idea for the trade, is a foundation for the trade, and foundation for the trade is that we have very obvious level of resistance and it is going to be broken. It is going to be broken, or in other words, we have very good odds of breaking this level, very good odds of the market breaking this level, and it happens. Well, market not only breaks this level, it is also going higher due to changed background in fundamental field, because we had a FOMC announcement. The Fed came with an announcement and it pushed the market higher here. All right, guys, have you got the idea of capturing a reversal trade here, the short-term reversal trade in the direction of this short-term trend? Well, it's not a trending action, right? It's a trading range. It is a trading range. Actually, it's not a trend. But we see the market leaning to the resistance level, to the resistance area, leaning to the resistance area, and we are going to capture this break. It is a breakout momentum trade. It is very short term. It can last no more than 1 day or at least 2 days, but I hope that you got the point. If you are unable to capture a breakout trade, you may want to capture a reversal trade or a pullback trade here. All right, it doesn't look like a reversal, isn't it? Because does it? Because it's not a reversal. It's a trade for a continuation. Now let's switch to reversal trades. Really, reversal trades that will look like reversal trades. Fading the correctional move, or going against the correction, going against the short-term trend or short-term rise in action, was clearly shown recently on the gold. I don't know, guys, how many of you trade the gold, but it's my favorite market among currencies as well. I very frequently trade gold. It is a pretty mature trend. It was pretty mature trend with quite a history, and we know that in such market condition, trend is unable to resume very quickly. It has to repair the structure. What do I mean by repairing the structure? When I see the rotational center, which is 1276.94, I know that market will tend to build a measured move around this rotational center. What do I call by measured move? The measured move occurs when you see the second leg equal to the first leg. All right, I will answer your question a little bit later, okay? All right, what are the parameters of envelopes for intraday? It is 21. It is 21 for 30-minute chart, and it can be 10 for 1 hour chart. All right, guys, let's I will get back to your questions later on, which concern topics not related to the topic of our webinar. All right. All right. The measured move. The measured move. I see that AB lag will be equal to CD lag. CD lag. The main thing here is to properly or correctly identify the rotational center. I will get back to this point in 1 minute. All right, so before the D point will be touched, trend is not going to continue. It is maybe not a law, it is observation. Trend has very small or very modest odds of continuation. Many traders also may want to trade here in this point. They want to go long. They see triangle, right? They see triangle, they see flag, they see many patterns of continuation. And they want to go with this trend. Market sort of holds around those levels. I mean 12. Just a minute, I will see what the level it is. 1276. Market holds around this level, and many traders try to go long here, and that's why they are caught in their long positions. Until the market will reach the D point, the trend will have very small odds of continuation. So I can capture a reversal trades right here. How do I do that? How do I do that? All right. Let's start with the rotational center. Those of you who have been on my previous webinars, you know how I identify rotational centers. First I start with points of the least volatility for the period. I watch for combinations of dodgy bars or dodgy candlesticks that are completely that shows completely reduced volatility, like it is shown here at the end of the May 5th. Do you see this sequence? It is of course it is the night session, right? It is the night session. It is the time between the closing of the US markets and opening of Asian markets. But nevertheless, it is relevant information for us. You see absence of activity, dodgy bars, dodgy candlesticks, absence of activity. Well, for example, you can see also, I don't know, here, you can see it here and here, but it is not as small as in the point 1. Let's mark it with the point 1. The point 1 is really the least volatility for the period. And the second clue is that market touches this level later on. It tests this level. It validates this level. It validates this level. All right, we know that this level is good to go, is good to use in trading. Well, for example, when we work the breakout momentum trade, it is not a reversal trade. It is continuation trade. But market was unable to reach the D point at May 9th, right? It was unable to reach this point, though the market has gone lower for the quite a distance. But nevertheless, it was not able to reach the D point, which is 1250, right? It has reversed back. How do I trade this reversal? Well, first of all, I might want to see the reduced volatility when I see the ATR showing me lowest low for the period of 3 to 4 days, like it was at May 17th. I start today, before the European session starts, I see that ATR with parameter 21 for the 30-minute chart shows me the least value for the period of, I don't know, maybe it is 2 weeks or more. It is pretty long period. So I might want to go against this level. I don't want to go long, I want to go short, capturing this small breakout from this level. This time it was not working. At the May 17th market has gone lower, but it was pushed back to this level again. And again I can continue for the next day. Oh, let me raise my drawings. I don't want just to sell and to place very big stop. I don't want to do that. I want to have as small stop as possible. That's why I combine breakout momentum strategy with a reversal strategy. Market stands at possibly pretty high point, and at the beginning of this day it breaks out this level with this candlestick, with this bar. This bar is closing at the outer side of this level. We have a level, we have some action, and we have a bar closing at the outer side of this level, right? I use high and low of this bar to build a resistance area, All right, so I combine breakout momentum strategy, or at least I can re-enter once market comes to the resistance area. It is also suitable. Once market comes to this area, I can re-enter because it is a good point to enter a short position, because until market will reach 1250, it will not go into to go higher. I know that market will possibly generate this swing. I had opportunity to enter this trade 3 times. 1, 2, 3. And even this one is small pullback. Well, if I am not too greedy, I can place my stop below, above this point. Well, my stop loss will be twice bigger than in previous pullback, than for the previous pullbacks, but it is also suitable. All right, and finally, you see that it is a reversal. It is a reversal. So this level is protected. It is a reversal because I initiate my trade pretty high relative to the current price section. Eventually, it is a highest point of the correctional move. Well, it's not the highest point of the correctional move. It's an average point. But I'm okay with that because my stop is pretty small. I can gain up to, I don't know, 7-to-1 profit-loss ratio for this trade. I'll now watch the questions. All right, please zoom. All right, I will zoom it for you because possibly the picture is too small. That's the level, right? That is the level. That is a candlestick that closes beyond this level. All right, it closes beyond the level. The same like here. Well, it maybe 1 pip. It is not closing beyond the level, but I use this candlestick number 1 and number 2. So, for example, at the day of May 17th, I have resistance area right here. At the day of May 18th, I have the resistance area right here. This trade is breakout momentum trade, so I go with the trend. I go with the small intraday move, but I combine this intraday breakout momentum trade with the larger context, with a larger time frame. And eventually, you see what happens? We are able to capture the 2 nice trending days here. 2 nice trending days. Structure is being repaired in this case. It is being repaired, market goes down and it reaches the D point. Let's once again go through this concept. Sorry. AB equal to CD leg, right? It is a principle of a measured move. That's why if you decide, for example, to sell right here, to sell the gold right here, it is not a good point anymore. It is not a good point to sell because market had reached the D point. What do I mean by that? Market can reverse back, it can rotate back and forth, but this is not a good entry point for a short position anymore. Is it a good entry point for a long position? Well, not yet. I'm not sure because because no, it is not a good point for a long position. Market can generate up to several scenarios. It can go lower, it can rotate, it can reverse. I don't know which scenario will be possibly the best to apply here. All right, let's continue. I hope, guys, that you have caught the concept of working with the rotational centers. Once again, I will repeat it for you because it's very, very important, and it will help you in trading, because it's considered that support and resistance levels are located at the extremes, at the borders of the range, but usually they are located in the center of the range. Reduced volatility tests with the pullbacks, I call it validation. And there are numerous opportunities to trade this level. For example, you can go lower here. It's not a reversal, right? It's a momentum breakout. You can, I don't know. Well, I was trading also on the short side during the May 16th here. I have protected my position, and it was closed with a small profit, or it was possibly the break-even point. I was trading here. Well, if I'm a day trader, if I'm a very short-term trader, I could have closed every position in a profit, having 3-to-1 profit-loss ratio. But as I'm a swing trader, I am intended to hold my position overnight. I usually keep my position overnight, and I need to survive during the pullbacks. I need to see something like that. That is a swing trade, right? That is a swing trade. It's not a day trade, but it allows me to capture significantly more interesting or lucrative opportunities than in day trading, with less commitment to the markets. All right, let's go further. Another example also captured from the recent trades, from the recent examples, is from Euro versus British Pound. It is a cross pair, and it can also be traded. Well, what do we have here? If you have been on in the previous webinar, I don't remember whether I was talking about those patterns or not. I called it elongation and V-shaped reversal. Well, I will repeat it for you. Elongation is a sideways action, is a trading range with low volatility when market goes back and forth with decreased volatility, and it is unable to break the higher border of this range for a long period of time. Well, in this case, it is 1 week. It is 1 week. If we compare this action to the previous rising action, the trading range usually exceeds the rising impulse maybe 2 times. In other words, it has taken around 3 or 4 days for the market to rise, and it has taken around 6 or 7 days for the market to consolidate. Well, you can build a triangle here. I don't know. You can build a triangle if you like those chart patterns. I call it elongation. It doesn't matter. What do we have later on? We have the breakout, which is false breakout, actually. You could have traded within a trading range, but that's not what we're talking about on this webinar. Yet it is also a reversal trade when you identify the rotational center. The rotational center is located, guess where? The rotational center is located right at this point. It is 0.7898. We see the same setup like for gold market. We see the level. We see the market testing this level several times. And you could have traded this level. You could have traded on a breakout of this level when you see decreased volatility or the least volatility for the period of, I don't know, more than 3 to 4 days. It is the beginning of the day, and market breaks breaks this level to the downside. It is not a reversal yet, but it is also possibly, well, the trade location is close to the high of this correctional swing, right? It is close to the high of this correctional swing. Yet the market is not going to go down for another 2 days, and it pulls back to this level, and it pulls back. Now, how do I identify the resistance area here? That is a rotational center. The red point or the red line is a rotational center, and I identify the resistance area by the low and the high of the candlestick, which breaks this level and closes below this level. Let's mark it with a background. All right, that is, guess what? That is a resistance area. You don't need to see any confirmation from a candlestick pattern here once market comes to the resistance area. You may sell, placing your stop just above this point. Now, why do you want to go short? It is, it's not psychologically comfortable to go short here because market had reversed, and it's very easy to say, all right, market will go higher here. Why in the world it should go lower? I would say that the reason is the V-shaped reversal. It is a reversal that looks like the letter V, the English letter V. Basically, the large time frame or the big buyer is not going to leave such traces on the chart. They don't buy the market this way. If they buy the market, they will possibly show you something like this, more significant action. This time it was not significant action, it was just a buying tail, the single buying tail here. So you know that market will test this point, test this V-shaped reversal in 2 days, 2 to 3 days. It takes 2 to 3 days to test this extreme. And again, so you know this foundation for your trade. The foundation for your trade is a short-term ability of the market to test the extreme. And the second thing is a risk. You can calculate a risk because market comes to the resistance area. You know where to place your stop. You know where to place your stop, right? And you are placing your stop above the resistance area. And it is a reversal. Here it is really a reversal. This time it is a reversal because you enter a short position, you place your stop, you go with the market. And the second thing you want to know is where to take your profits. Where to take your profits. You know that this triangle is pretty elongated, so market will possibly break with increased volatility. You may want to capture more distant targets, and to do so you might measure previous volatility of the previous swing. How can you measure it? You take the point from which the market had started to grow, you take the rotational center, and you measure average volatility of a swing here. And you just use this number as a reference to exit your position. Well, of course, market here can be pushed down, and here market shows very nice rally to the downside. But I'm not sure that this rally is predictable. I'm not sure. The more predictable action is action inside of the trading range. I mean this large trading range. Well, trading action outside the trading range is not so predictable. All right, let's get back to questions. How can you tell me how to draw support and resistance lines that you draw in the red color? It's not a support and resistance, sorry, it's a rotational center. It is a rotational center. Support and resistance are not lines. They are areas. They are not lines, they are areas. For example, the area marked with a green color here, you see that is not a line. That is not a line. It starts from 0.7891. It is the lowest point of the resistance area, and the highest point of the resistance area is 0.7907. So it is possibly equal to 15 pips. It is as wide as 15 pips. How do I identify this red line? Okay, let's once again go through this process. First of all, I watch the previous price action and I want to know whether I have spots of lowest volatility for the period. In other words, I want to see sequence of doji bars and candlesticks like I see here. Absolute absence of action. No action. Market is dead, right? It is not showing anything. Market is absolutely dead and it can last for 2 or 3 hours. That is very important point. I call it the point of balance or the rotational center. Market comes back to this point and it shows no action, absolutely no action. And the next day we see that this level is being tested several times. Of course, market is breaking this level to the upside or to the downside, but you see that this level is tested several times. You also are able to see that this level was tested before. Well, market sort of rotates around this level. It goes back and forth around this level and it gets back to this level once again. So that's why I call it rotational center. Rotational center is a reference point to manage your risk, or in other words, it allows you to build the resistance or support area. In this case, when market goes down, I build the resistance area around the rotational center, which is 0.7897, right? I build this resistance point around this rotational center. How do I build it? First, of course, I need to have a setup, a trading setup, because I don't need just to know the rotational center. It doesn't make sense to me if I don't want to earn money with that. To earn money with the rotational center, I first need to have a setup, and my setup appears here. Before the European session starts, I see the lowest value of the ATR for the 4 days. For the 4 days. I see. All right, volatility is very small, so market can break to whatever direction. I see where the market is traded right now. Once I see the situation, I see where the market is traded right now. I fix that market is traded above the rotational center, possibly, I don't know, 20 pips above the rotational center. So for me, it is too late to go long. It is too late to go long, yet in some cases market can go higher. I will just let the market go and skip this setup. But if I see that market breaks this level to the downside, I know that the volatility can break because it was the lowest for the period of 4 days. Now it can be the highest for the period of 4 days because volatility goes from lowest value to highest value. In other words, I can see the trend in action. I can see the breakout because volatility is a cyclical thing, right? It goes from low to high, And that's why I know that I can go with this market in this case. During this day, well, we have seen the breakout, but there were no continuation here. Yet, in 2 days that followed, market came back to the resistance area. Market came back to the resistance area, right? So I was able to enter a short position here with a stop located outside of this area or above this area in this case. And you see that I'm capturing a reversal here. I'm capturing a reversal. Well, I'm not actually holding position for too long. I'm closing below the low, or sorry, above the low. But also it allows me to achieve more than 3-to-1 profit-loss ratio, actually close to 4-to-1 or 5-to-1 profit-loss ratio. That's the way it works. Now let's get back to the New Zealand dollar and see what happens here. The New Zealand dollar is still in play. My entry point is 76.57 here on the second account. On the second account I was showing you this trade. That's the way it works. I had entered at a 58 point. 58 I entered to the short side. Alright, this trade is still in play. The trade is still in play. Alright, let's get back to the presentation. I like trading setups inside of the trading range when market is going to exit the trading range because volatility is increasing and such trades have pretty good expected value. And at the same time, those trades are reversal trades. And alright, let's talk about mean reversion trades. What is mean reversion trade? When we identify target areas or areas outside of a trading range, we know that the market can reverse from those areas. Yet we have to switch to higher time frames, at least to the 4-hour chart. At least for the 4-hour chart. Once you see a pretty good identifiable trading range, in this case we have extremes number 1, extreme number 2, and I draw my target area below the point 2, market goes down, and I can spot an opportunity. I can identify a candlestick pattern, but I can do it only starting from the 4-hour chart. I don't pay attention to candlesticks on 30-minute charts, on hour charts, and for example on 15-minute charts or 5-minute charts. I care less about those patterns because it's too much noise in those time frames. I pay attention more to levels, to areas, to simple patterns like breakouts, but I don't pay attention to candlesticks. But once I switch to a 4-hour chart, I start paying attention to candlesticks. And here is an example of how it works. What do I want to see as a pattern? I want to see engulfing pattern. Engulfing pattern. That is built from white candlesticks for the long trade and with black candlesticks for the short trade. Black candlesticks for the short trade. That's the way it looks like. For example, I can have, I don't know, something like that. I don't trade, well, pattern number 1 and pattern number 2. I don't trade pattern number 1 because it's a form of bottom picking. The pattern number 2 is better because it's a trade with a confirmation. It's a trade with a confirmation. My stop has to be placed slightly below this model or below this pattern. All right, the number 2 and number 1 and number 2. If you miss the trade on number 1, you can enter a trade on number 2. You see that your stop loss is not very tight. It can be equal to 70 or 80 pips in some cases, so it's not very tight. It's not 15 pips, it's not 20 pips. But as I have said, this time frame is H4, and it's okay for such time frame to place pretty tight, pretty distant stops. What about the targets? Most of the time, traders think that, all right, my target is located on the opposite side of the range, on the opposite side of the range. I would say that the expected value of such target is not very high. In other words, there are greater odds that the market will reach the center of the range, and start rotating, start going back and forth, and maybe will go down again. So there are great odds of such behavior of the market. So I would prefer to close my position at the target area located in the center of the range, or at least to, I don't know, to extract 1/2 of my position or 1/3 of my position at that point, because that's a target area. And you see how it works. We capture small pieces of those swings, capturing 1-to-1 profit-loss ratio, having probabilities on our side in this case. And that's a good way to go, because for example, if you try to set your target at the opposite side of the range, you may face situations when market goes down it tests center of the range and it goes down, it will be a very frustrating experience to capture a profit and to give it all back to the market. That's why for the mean reversion trades, it is good to spot smaller targets. And again, one example again. Example of two patterns on the 4-hour chart. Once market comes to the point which I call target area, located beyond extremes, you can also spot such patterns. Two candlesticks in a row, two black candlesticks in a row. You spot a pattern and you set your target in the center of the trading range. The same situation again, market goes higher, it shows you pattern again. You have not very good profit-loss ratio here because the market, because your target will be pretty close here. I would say that I will not accept such pattern. As for the lowest setup, I'm not sure that we have engulfing pattern here because we have something like, sorry, just I will redraw. We have something like that. It's not an engulfing. Engulfing pattern occurs only here. And you see that the entry point here is very close to possible target area. So such pattern has to be filtered. Also we have fake patterns which look good to be true. They're very small and market is not showing us any borders of a trading range yet. So market just goes higher and higher and higher, and even if we had previous trend, patterns are very small. So first you have to let the market settle, let the market consolidate, and only after that you can try to capture patterns. All right, we have one here. Let the market settle, let it consolidate, and only after that you can capture a pattern. Let's get back to the Canadian dollar, for example. I was showing you this example so far, and the question was, is it a good market to fade? Is it a good market to go short? Let's try to identify it. Let's try to decide. We have 4-hour chart. Here we had trading range which is pretty small or pretty tight, right? Pretty tight. Market has emerged from this trading range now. It is 4-hour chart, and reversal pattern can show up in the recent activity if we see something here. If we see that market shows us, for example, two candlesticks, two black candlesticks here, we can take the low, take the high, take the average. That would be our stop loss point, and we can capture 1-to-1 profit-loss ratio trade. It is a reversal trade, yet it is not very, very profitable trade in terms of relationship profit and loss ratio. It can give us modest profit-loss ratio, but nevertheless we can capture such patterns. You can capture such patterns if you like. All right, we have also the topic which is pretty big about volume and open interest. I'm not sure that we have time now to go through this topic because it requires separate webinar. I was naive enough to include this topic today. Well, I think that we will possibly talk about this in the next webinar, about open interest, about volume, about applying open interest and volume to our trading, about confirmation. Guys, just give me 1 minute, I will be right back. All right, I'm back. So I would suggest to talk about this topic in next webinars. It is not the last webinar, and if you are interested in this topic, we can do the webinar on this topic. All right, that's what I was going to tell you today. If you have any questions, I'm ready to answer all of your questions. Do you have any questions, or when there is when nothing is understandable, there are no questions, right? All right. Can I get recording? I think yes. The recording is this webinar is recorded. I think that it will be uploaded on the YouTube Exness channel. So I think that organizer will make a follow-up email, or you can go to YouTube and just to search for this webinar. It will be called Trading Reversals. Trading Reversals Exness, and you will find the Exness YouTube channel, and you will be able to find this webinar in the list. All right, any more questions? Please use our chat, our questions chat, to type your questions. All right, thank you for the interest. I appreciate you coming to this webinar. I'm hoping that you will capture valuable information for your trading. Right, I understand that things that we are talking about are not so familiar to the majority of traders, so they will need rethinking. You will need possibly to watch the video once again. All right, Asif, please give us your question. When we have mostly our perfect reversal, you mean time of the day. Well, there are two windows of opportunities. The first is before the European session starts, is 1 hour before the European session starts, and the second is possibly 4 p.m. London time. It is overlap of European session and opening of the US session, because extremes usually are set in the market during this time, 4 p.m. London time. Sometimes market is rallying, is going higher on lower just since the beginning of the day. And if you see that the Asian session has not shown you any meaningful action, it was trading range with very small volatility, you can try to capture a breakout on the European session. It is a very good time to capture a breakout, because if the day will be trending, you can spot, I don't know, the low of the high of the day. Sometimes it works very good. I was showing you such trades so far. For example, if we get back to previous setups, like I was showing you on gold, you might notice that all trades are possibly opened before the European session starts. I will again mark it for you, for here and here. It is the beginning of the day. It is the end of the Asian session. It's a very good time to initiate a trade. Do I use only M30-minute time frame for my entries? Well, sometimes I watch smaller time frames, like 5-minute chart, for confirmation, but basically I don't watch any candlestick patterns on 5-minute chart or so. I just want to see in detailed mode how the market moves. how it reacts on the level. So yes, I pay attention to lower time frames as well, but they don't play the dominating role in my analysis. Most of my intraday charting analysis is done with the 30-minute chart, 30-minute and daily chart. I start my analysis with daily chart, then I switch to 30-minute chart. That's my time frame. I don't know. You can use 40-minute chart. I don't know. I know traders that use unconventional time frames, like I don't know, 35 seconds minute chart. I know a trader that employs 35 seconds minute chart, and another trader used 3-minute charts. It is just a way to organize the data. I use 30-minute chart. It's okay for me because I was employing market profile for a large period of time, and market profile employs 30-minute chart to build the blocks of this profile. Market profile is also the alternative way to organize the data. Maybe if enough attendees will be interested, I will do the webinar on the market profile. All right. Then if we have no more questions, I appreciate your interest to this webinar, and thank you for your attention. See you at the next webinars. And we are finishing the webinar. My name is Stanislav Bernuhov, and this webinar was provided by Exness company. I wish you good trading, manage risk, be careful with the markets, manage risk, and learn something new every day. With that, I'm saying goodbye and wish you a good trading.